Essentially, we've got a bilateral market, almost binary. You've got spells that we've had now of dollar strength that's just kind of had a little bit of an ending. During the dollar strength period, here's how the theme goes. It's usually associated with oil strength even more than the dollar, so it's an oil squeeze up, which is part of a stagflationary move, which is going to lead to a hyper-stagflation, is what we've predicted as our major macroeconomic environment. More on that in a bit. But in terms of market trading, if you're long oil, you're also partially long a dollar, even though that's counterintuitive because oil is obviously priced in the dollar. And in our view, we long the dollar during that period, which has just kind of had an ending, a little slap in the face. During that period, you want to be long the dollar against the Korean won. You might even have a little bit of long the dollar against the yen. This is a dollar assertive period. It's been a softer period for gold and silver. That's obviously changed just recently. We'll talk about that. But more generally, the last 2, 3 weeks that are behind us, it's been a bearish period for tech and tech stocks. It's a sell-off period for Bitcoin, and it's been a soft period for gold and silver during that, which is the stagflationary element. Why? Because debt and fiat dies. Rates have been going up on the bonds down as well. So the things that go up are the dollar and the oil during the Hormuz narrative. And all the other things I mentioned are largely short. However, what we are seeing now is we've had a little backing off of the oil. You've got the tech stocks rallying. You've had a little bit of a pullback on the rates on the bonds. You had a bit of a Bitcoin mini bounce, and you've got a much more energetic bounce on gold and silver that has come in, and you're getting a rally. I want to warn a little bit, and we'll go to the charts when we do that, but I think there's a third sell-off on the precious metals still to come. So even though you're rallying now, and it's super tempting to be as a trader, to be buying that rally on gold, I can't answer how big a scale type slap down, and typically you get selling in waves of 3. I do just want to say, with this kind of bounce on gold and gold leads, I really think the 3.5 grand callers are going to be caught short. I don't think you're going to be seeing that. But who knows? It will take a different degree of crisis. That means they're prepared to let everything go, all fall down. If you get the 3.5 grand to the downside run, which can happen, it's just not my highest probability option. If we get that, the Nasdaq and Bitcoin will be horrendously down in that, and you'll be in, okay, this is the correction. And there is the possibility that we're going to have that moment. I just think they're going to drag this out in stages, and I don't just think you're going to get the whole puke, right now, every last chunk, and you get projectile vomit the lot in the next session. But so I think we're going to continually to have bad, worse, bad, worse. There's going to be hot, cold, hot, cold. You're going to be kept tap dancing because generally traders lose in those markets because they're chasing momentum and responding to news. And the minute you start responding to one form of news, by the next week, they're pivoting it on you. So you end up always, buying tops and selling bottoms, and you want to avoid being caught in the reactional cycle. So I tend not to listen to the news, just look at the charts and say, I think you're going to get sold off one more time, gold. I stand ready to utilize that opportunity, and I'll wait till you show me the bottoms in. I'm not trying to buy the bottom. I'll let the first 5 or 10% put real volume in. That's the value also, and I'm using 2 different kinds of candles here, but the fat candles show you real volume as well. And right now, these 2 candles are not, in terms of 12-hour sessions, not particularly fat, and they can be retaken back. You'll note when you get to lows, you tend to get the bigger volume, real capitulation selling here, and then real value buying there. And even this candle and the one in between, that was real. Okay, guys, if you're coming down here, we're buying. Those 3 guys had quite a bit of fatness on them. These are quite skinny belinky, as I would say. It was very much like the in-betweener waiting for the news. Very small, low vol, you get the spiller. So I'll watch and see. Those can be taken back relatively easy, given the volume that they're going up on. Well, that's GLD, which is quite clearly mimicking. You can see there's a commonality with
Right.
the gold, and you can see the tops. You could see that we were getting fatter on the green here, and then you had a super fat red with quite a volatile session. That was a bit of a warning because you gapped open. This is on a 12-hour even, so it's not even a daily chart. And you came right the way down, rallied right the way back up. Very volatile. If I put the volatility index on that, you would have seen that that was getting pretty high. Interestingly, it might have a little bit flag-like type structure in terms of it. All of these structures, both on gold and on silver, are what we call continuation of macro trend structures, despite the fact that they sold off a great deal. Remember, we called the
Right.
start of a generational move at 25.9, and silver's still at 77. It's still at nearly three times where we called the start of a generational move, despite having a 45% correction in that. All
Hmm.
ongoing. We've got a $333 target where you'll gestate again. Then we've got a single digit gold silver ratio, which you'll see it be quite a bit higher still as well. So this is in the same category,
Hmm.
Andy,
Yep.
of what we were talking about. This is just continuation trends with cycles in between. And you've had the one sell-off, you've had the second sell-off. The one sell-off here was really violent, big volume, and you can already see the volume reduce quite a lot.
Yep.
Yeah, you are a little bit uppity on quite thin volume, which sets you up for if you get a
Ooh.
bit more uppity for that third sell-off. But that doesn't mean you go all the way to the bottom of the channel range. I think you could do something like that. And the break that you want is that capping
Yep.
descent grind line, which is the top line structure in a flag-based continuation situation. So this is still a flag. You look at where you come from. That's a big flag pole. That's a
Yep.
flag on a flag pole. So there's no crying in baseball. This guy goes higher in due. If your time frame is long enough, this guy goes a lot higher.
Yeah. That's excellent.
And don't forget they had a perfect storm, which they weren't really fully given the gift of before that we had, and we'd called this that oil was underperforming gold for an extended period. So you had
Mhm.
very cheap energy for mining, and you had very high mining prices. You've had a short-term inversion of that, which has affected margins somewhat with the increase in the energy costs and a decrease on the top line number for revenue. So there is a little bit of a multiplier effect on that, and you saw that. So you're in on the gold silver ratio. Something else worth watching. You had a very big move. We actually, funny enough, drew this on a smaller time frame. You had a little squeeze there that was pointing to the gold silver ratio going up, which was pretty bearish generally. You normally don't want that in the bull market. It was that little guy over there. You got overperformance, you got a flag again, and you got a further surge upside. This was at the worst moments, and silver got the hardest sell off first time. Remember that. And what I've been highlighting is now, if I change color, you're kind of in a different space. You're in a flattening, reducing volatility. I probably want to do this. You might have three there. Now that could break easily to the downside, but you can see the volatility is reducing, and we'll see. But maybe first it goes a tiny bit higher on the range before coming down and breaking. It depends how gold and silver react on this current rally and possible rollover. I'm assuming in my base case that there would be one, but it's not a guarantee, or it's already happened and was much smaller, hence the disproportionality I mentioned. The exciting thing for silver is this is almost a better setup than the gold one. Gold will lead, but this one is pointing to a disproportionate reaction given how hard it sold off here. It almost had its worst sell to start. And I want to just highlight there is a difference here between silver and gold. Silver got properly spanked on that first instance. You were nigh on a 50% correction. You were at 121.67 and then you're down at 63 at the low. Now, if you double that, that takes you to 126. You're nigh on 50%. We're probably knocking on a 45% correction. Gold being more robust held up better in the first instance, but had a far nastier sell-off period here. Once it was quite clear we were selling off for a second, and it had an extended second in sell. Silver has shown that actually it was more robust because it had taken a bigger beating first time. It didn't rally as high as gold. So remember, I highlighted that you did a 78.6. So silver was flatter on the down leg and the recoil rebounds. But since then, the compression from these levels has been far less. So actually on a relative strength basis, since this sell-off occurred again, silver's been stronger. And we prefer this overall structural pattern, which you might note